So the other day I was watching PPC Ian's latest video, and in it he said something that actually got me really stoked about what's going on in the market right now. As you surely already know, things have not been great lately, and share prices all across the board are getting killed. But what Ian pointed out is that it's not just the ancillary stocks. It's not just these second-rate cigar butt type stocks that are correcting. Right now, even the big blue chip stocks that we consider to be of the highest quality are coming down and presenting to us investors a fantastic buying opportunity, which is very exciting. In this video, I'm going to tell you about 3 dividend kings in my portfolio that look ripe for the picking and I will definitely be buying more of. And later on, I'll also show you a few more dividend kings that I don't personally own, but also look like really solid buys right now. But anyway, before we get into all of that, in case you're new to the channel, my name is Ryan, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. And also leave me a comment below and let me know which discounted stocks you've been picking up lately. There are tons of great buying opportunities out there right now, so I'm curious to hear what you think is looking good. Anyway guys, the first one on my list is going to be Lowe's, who has really come down a lot in a very short amount of time, and retail in general has just been getting hit hard lately, at least some of which is happening as a result of rampant retail theft this year, which is negatively impacting these companies in more ways than one. Now in the case of Lowe's, they are officially in the red in 2023. Year to date, they are down 0.08%, and looking at their performance just in the last month, they are down a whopping 14%, and in this time period, they've gone from being up over $230 per share to now, I mean, you can see the current share price less than $200 per share. And taking a quick look at some of their valuation stats, starting with the PE ratio, it's sitting at 14.87, so really not too bad, but this is also 15.5% below the company's 5-year average PE ratio, so a little bit of a relative discount there. And if we scroll down, taking a look at the forward price to cash flow, this is even more impressive, 9.26, and this is 32.5% below the company's 5-year average. And taking a quick look at my Lowe's position over on my dividend portfolio tracking spreadsheet, which you can start using for free. There is a link to grab this in the description of the video. But anyway, with Lowe's crazy drop in share price over the last month, this has brought the current price really close to my cost basis. My average cost right now is $195 per share, and you guys can see I have 15 shares of Lowe's, but the current share price is only a few bucks above that, which if we slide over and look at my current return, I'm up less than 2% with Lowe's right now. So like I said, very close to my cost basis, and I would not be surprised if this position dips into the red like so many others have, and I'm kind of hoping it does so I can pick up more shares and lower my cost basis even more. Now looking at Lowe's against the rest of my portfolio, even though it's already my 4th largest position by weighting, making up 6.5% of the portfolio, Lowe's is only generating about 3% of my total dividend income, so there's definitely still room to increase this position without Lowe's becoming too overweight, and I think right now is a pretty perfect time to start doing that. Now jumping back over to Seeking Alpha and looking at the dividend stats, this company's forward yield is sitting at 2.2%, which is not too shabby. This is a very high growth dividend stock, as we'll see in a moment, so this yield is to be expected, but what's impressive about this is that the yield is currently 22% above the company's 5-year average. So just from a cash flow perspective, it looks like a pretty good time to accumulate more shares. And then looking at the rest of the dividend stats, starting with the payout ratio, this is very low, just about 31%, which leaves plenty of room to continue growing this bad boy, and their history of doing so is phenomenal. Like I said, this is a very high growth dividend stock with a 5-year CAGR just below 20%. Love to see that, and they have been growing this dividend for the last 59 straight years. But anyway guys, moving on to the next dividend king that I would love to swoop up some more shares of. This one is Johnson & Johnson, who is seeing quite a big drop so far in 2023. They are down 12.13% year to date, and then looking at their performance in the last month, they are down 2.8%, so not a crazy drop, definitely not as big of a drop as we were seeing from Lowe's. But with this drop, Johnson & Johnson is really not too far off from their 52-week low. If they just have a couple more red days, they'll be there. And out of all the dividend kings that we're talking about today, Johnson & Johnson is the only one that I'm currently in the red on, so it's definitely a good time to average down. Looking at my J&J position, I have about 22.5 shares at an average cost of $163.59, so the current share price is quite a bit below my cost basis. And sliding over, looking at my return right now with this company, I'm down 4.25%, which is really nothing too crazy. And as far as this company's allocation to my portfolio, it's currently my 3rd biggest holding by weighting, making up 7.5%. So I do have a pretty hefty helping of J&J, but in terms of income, it's only 4.6%, and it's only bringing in about $100 a year. So I would not at all be opposed to boosting that up while I have the opportunity. And then jumping back over to Seeking Alpha, looking at the dividend stats, J&J is officially yielding above 3%. I love to see that, and its current yield is about 14.4% above the company's 5-year average. And then looking at the rest of the dividend stats, I would say this is a very balanced dividend scorecard. The yield's nothing too crazy, it's not too high, it's not too low, it's kind of a Goldilocks yield. And then the 5-year growth rate just under 6%, I think that's looking pretty Goldilocks as well. It's not too high, it's not too low, definitely sustainable, and they've proven that they they've been able to sustain this growth with 60 straight years of increasing the dividend. And with that, guys, that brings us to the third dividend king that I just cannot wait to swoop up some more shares of. This is Coca-Cola, which I haven't added to in a very long time. It looks like my most recent Coca-Cola purchase was in July last year, where I must have just reinvested some dividends, and it doesn't look like I picked up any shares outside of that since January of 2021, so it's been almost 3 years. And out of the three kings we've talked about so far, Coca-Cola is seeing the biggest year-to-date loss. They are down 16%, and then just in the last month, they are down double digits, almost 11%, with a 4% drop just today as I'm recording this video, which puts them at a new 52-week low. And with this substantial drop in price, guys, the current share price is getting really close to my average cost. I have 23 shares of Coca-Cola at an average cost of $51.44, so there's about a $1.50 spread between the two. And looking at my returns, this leaves me with a sub 3% share price return right now with Coca-Cola, so it's getting pretty dang close to break even for me. And like I was saying with Lowe's, I would not be surprised if this ends up getting into the red, and I actually welcome it. Out of all the dividend kings that we've talked about so far, even though I am seeing the highest share price return still with this one, I gotta say Coca-Cola is probably the one that I'm most antsy to start buying again. As we saw a moment ago, it's been a really long time since I picked up any more shares of this company, and because of that, it's become one of my tiniest positions and only makes up 2.7% of my portfolio by weighting and only 1.8% by income, so I am just chomping at the bit to buy more shares. Anyway, taking a look at Coca-Cola's dividend stats, the yield is looking good. This is the highest we've seen all day at 3.34%, which is 8% above the company's 5-year average yield. And looking at the rest of the dividend stats, these are okay. I mean, the payout ratio, it's gonna be the highest that we've seen out of the bunch at 69%, but this is also 8.25% below the company's 5-year average payout ratio, so I would say that is a positive. And then the 5-year growth rate's nothing to speak about. I mean, the forward yield and the growth rate are kind of neck and neck there, but the dividend growth is fantastic. 60 straight years, you gotta love that. Anyway, those are the three dividend kings that I plan to start adding some more shares of here moving forward. And with that, you might have noticed that there are a couple other dividend kings in my portfolio that did not make this list. One of them, believe it or not, is Procter & Gamble, and I would love to add some more Procter & Gamble. I would. It's one of my favorite stocks, but it's already my biggest position. So with my limited contribution dollars, I would rather bring up some of my lesser weighted positions like Coca-Cola or Lowe's. And then the other one I didn't mention is Altria Group, and I'm actually taking a loss on Altria right now, but I don't want to add any more shares because it's already 9% of my total income, and I don't want too much of my income coming from one particular holding, so I don't see myself adding to Altria right now. Anyway, switching gears outside of my portfolio, there are quite a few other dividend kings out there that also look like really solid buys right now, and I think you might want to keep your eye on them. The first one, guys, is Target, and it's pretty unbelievable to see what this company's share price has done this year. Year to date, they are down 30, almost 31%, and then looking at their performance just in the last month, they are down over 17%. My goodness, and I mean, at $105 per share, at the rate they're going, I would not at all be surprised to see Target under $100 getting into the double digits, which is going to be wild. Anyway, guys, next up is GPC, Genuine Parts Company. They are down 16% so far year to date, and then looking at their performance in the last month, they are down 6.6% and pretty much tickling their 52-week low right there. Another dividend king to watch is Hormel Foods. They are down 17.3% so far in 2023. Very big drop, and then just in the last month, they are down nothing too crazy, about 1.25%, but either way, Hormel is also right there at their 52-week low. Anyway, next up, guys, keep your eye on CWT, California Water Service Group, which is a water utility company who is down 22.6% year to date, and they are down another 2% just in the last 30 days, and really not too far off from their 52-week low. And then next up, guys, we have SJW Group, which is another water utility company who is down even more. They are down almost 28% year to date, and then in the last month, they are down another 7%. Very big drop, and like the other dividend kings we've talked about, they are right there at their 52-week low. Very close. And then next up, guys, keep your eye on Stepan Company, who is in the materials sector, and they are down 33% year to date. My goodness. And then in the last month, they are seeing another very big drop, about 16.5%. And like the rest of the kings, guys, they are at their 52-week low. But anyway, all of these dividend kings look like pretty great buys right now. And speaking of great buys, in this next video right over here, I've got 4 more deeply discounted stocks, all of which look like great buys right now. So click right over here to check them out, and I'll see you in the next one.